On January 28, 2026, the entire global capital network suddenly executed a ruthless mechanical severing of the Indonesian equity market. The immediate impact of the crisis wiped out over $80 billion in market capitalization in 2 trading days. The IHSG dropped 8%, forcing a total trading halt as institutional liquidity vanished. This chart tracks the localized equity crash against sovereign risk premiums. As the red equity line plummets, 5-year CDS, credit default swaps, a derivative measuring the risk of default on sovereign debt, spikes instantly from 73 to 86 basis points. Global institutions synchronized their response. MSCI issued a severe investability warning, Goldman Sachs cut equities to underweight, and FTSE Russell suspended reviews entirely. The scale of this withdrawal confirms a coordinated rejection of the capital market's structural integrity by global passive capital, far exceeding the mechanics of a standard correction. A global equity index methodology relies entirely on verifiable mathematics to dictate how passive funds allocate capital to a specific market. The algorithmic allocation relies on the foreign inclusion factor, the mathematical ratio of shares available for public trading. But local regulations permit hidden offshore ownership up to 5%. This loophole allows issuers to mask true control, crushing the available public sliver to near zero. This structural opacity, paired with coordinated trading behaviors on the exchange, creates artificially constrained free floats. The data fed into the index calculation formulas is rendered inaccurate. Global passive index funds are mechanically forbidden from tracking markets built on phantom liquidity. The algorithmic freeze was inevitable. An index downgrade is a mechanical execution. It forces massive passive funds to automatically liquidate their holdings, entirely blind to domestic economic fundamentals. This chart maps capital flight estimates by Goldman Sachs and Nomura across downgrade severities. A simple free float adjustment triggers a $2.2 billion outflow. A full algorithmic downgrade to frontier market status forces a $7.8 billion liquidation. The terminal scenario yields over $13.4 billion in forced selling. The sheer volume of this forced algorithmic liquidation wildly outpaces the absorption capacity of domestic institutional investors, guaranteeing market collapse. This chart projects the macroeconomic destruction from capital flight. $13.4 billion exiting puts severe selling pressure on the rupiah, projecting up to 10% depreciation. To prevent freefall, Bank Indonesia must execute defensive interest rate hikes, which crushes the sovereign debt market, sending bond yields spiking. Higher yields violently increase the government's debt servicing burden. This dynamic widens the national fiscal deficit by an estimated 0.2 to 0.4% of GDP. This monetary tightening directly constricts corporate credit access. The central bank must intentionally slow real economic growth to save the currency. A failure to regulate local equity manipulation mathematically engineers a sovereign macroeconomic doom loop. Domestic operators often assume that a downgrade is survivable because Indonesia's sheer market size would easily dominate the lower-tier frontier market index. This radar chart compares Indonesia's market accessibility against MSCI's newly created classification, the Advanced Frontier Market, populated by highly efficient European nations. Indonesia's restrictive foreign ownership limits and operational inefficiencies lag far behind the pristine, frictionless European Union standard frameworks of nations like Romania and Estonia. Quality-seeking institutional capital prioritizes operational integrity and absolute transparency over nominal market capitalization. A downgrade guarantees a permanent liquidity discount. Indonesia will lose its emerging market capital without capturing the advanced frontier market capital. This document outlines the domestic exchange's initial reaction, attempting to officially reject the proposed changes to the global index free float methodology. The methodology change targets one-way turnover. One-way turnover is the frictional cost incurred by passive funds when a market's actual available liquidity fails to match its reported data. Protesting global algorithmic methodologies is mathematically futile. The global capital market has already independently verified and priced in the local manipulation. Survival requires domestic regulations to ruthlessly align with global mathematics, rather than demanding global mathematics ignore domestic reality. This executive directive outlines the first non-negotiable structural reform, the mandatory enforcement of a strict 15% minimum free float. The second critical reform lowers the ownership reporting threshold to 1% to expose the UBO. The ultimate beneficial owner is the actual person or entity that ultimately controls a corporate structure, regardless of intermediate holding companies. Exposing the UBO is the only mathematical way to calculate an accurate foreign inclusion factor and destroy offshore corporate opacity. Enforcing this requires the new Anti-Market Manipulation Task Force, utilizing AI data labs to identify and prosecute coordinated trading behavior across the exchange. Less than 70 days remain until the binary MSCI evaluation in May 2026. The market ecosystem must definitively prove it is an engine for fair global capital formation or face absolute algorithmic exile.